Welcome to this explainer, Future CPAs. Today, we're literally hacking the Philippine LECPA exam by totally ditching rote memorization. You know, if you're a BS accountancy student prepping for Quiz 4 right now, you already know that just cramming facts, that's not going to survive the intense pressure of the actual board exams. Instead, we're going to build a solid 3-year retention logic tree specifically for estate tax valuation. We're going to wire your brain to truly understand the underlying mechanics of the law, making absolutely sure this knowledge sticks with you all the way through your 3rd year and right into that exam room.
So, let's just dive right into it. Think about this for a second. How exactly do you put a price tag on an entire lifetime of assets in a single day? To crack the gross estate, we first really have to understand the core logic of how the BIR, the Bureau of Internal Revenue, actually looks at a person's entire lifetime of accumulated wealth. They need a perfectly standardized, totally unshakable method to lock in a value for everything a person leaves behind, completely regardless of when it was originally bought, how much it depreciated over time, or even what currency it's in.
Here is our cognitive roadmap for today. We'll cover the golden valuation rule, real and personal property hacks, cracking corporate shares, valuing time with usufructs, and finally, a LECPA rapid bullet review.
All right, part 1. The golden valuation rule.
We're starting right at the trunk of our logic tree with the absolute golden rule of estate tax, fair market value at the exact time of death. This is your ultimate cheat code for the LECPA. You've got to anchor every single valuation to that specific exact moment. Why? Because the very second a person passes away, the right of the state to tax the privilege to transmit that estate vests instantly. Not a week before, not a month after. Boom, the exact time of death. That's when the snapshot is taken.
And listen to this quote derived straight from the tax code principles. It says, "Estate tax is governed by the statute in force at the time of death of the decedent." So if you ever find yourself getting confused on a super tricky multiple choice question with changing dates and wildly fluctuating values, just take a breath and remember this foundational rule. The time of death dictates absolutely everything, both the law applied and the value assigned.
Moving on to part 2. Real and personal property hacks.
Now let's branch out a bit. For real property, we're talking lands, buildings, condos. The government understandably wants to maximize the tax base, right? They want the biggest piece of the pie. So the rule here is remarkably simple. You just compare the schedule of market values, which is the assessed value determined by provincial or city assessors, against the zonal value, which is determined by the Commissioner of Internal Revenue. Your analytical hack here, always choose the higher amount between those two. Honestly, don't even overthink it. Higher value simply equals a higher gross estate.
Now, for personal tangible properties, things get kind of interesting because we contrast two very distinct rules based on how old the item is. Newly or recently purchased items, those are simply valued at their purchase price. Makes sense, right? The transaction is fresh. But older items, or things not recently purchased, think like a vintage watch or inherited family jewelry, those use a really clever proxy. You find its pawn value and you literally just multiply it by 3.
Okay, so here is the crucial part, understanding the why behind this rule. The BI knows a receipt from last week is completely accurate, but a 20-year-old receipt for a gold necklace? Totally useless for finding today's fair market value. They desperately need a reliable, standardized baseline. Now, pawnbrokers are notoriously conservative. They generally give you about 1/3 of an item's actual value. So the BIR just reverses the math. Pawn value times 3 gets you right back to an estimated fair market value. Understanding this BIR intent, that is your absolute best hack for 3-year retention. It just clicks.
All right, part 3, cracking corporate shares.
This is a super highly tested area on Quiz 4. If the stocks are actually traded on the local stock exchange, like the PSE, they're called listed securities. But on any given day, the stock market is bouncing up and down, right? So what exact value are you supposed to use? Well, you just average out the market's volatility for that specific day of death. You literally just take the highest quotation, add it to the lowest quotation, and divide by 2. It's the arithmetic mean. It's fair, it's completely objective, and it perfectly aligns with our time of death snapshot rule.
But contrast this with unlisted shares, stocks that aren't publicly traded. There's no daily market quote to average out, so the rules lock into the company's financials instead. Common shares, also known as ordinary shares, are strictly locked to their book value on or nearest the valuation date. But preference or preferred shares are locked to their par value. You really need to memorize this exact difference. Common equals book. Preferred equals par. Seriously, lock that into a mental folder in your brain right now.
Moving along to part 4.
Valuing time. Usufructs.
So how exactly do we value something that isn't even a physical object, but rather a right to use something over time? I'm talking about usufructs, rights of use, habitation, or annuities. Because these assets are inextricably tied to a person's lifespan, the logic dictates that their value depends entirely on the probable remaining life of the beneficiary. To actually calculate this, the Philippine system uses the latest basic standard mortality table, which definitely has to be approved by the Department of Finance. It basically translates the abstract probability of time into a very concrete present value.
And let's look at how we handle a few other time-bound or market-bound intangible assets. For annuities, we again look straight at the probable life of the beneficiary. For notes and accounts receivable, pay close attention here. You don't just take the face amount. No way. You take the discounted amount of the unpaid principal plus interest, basically bringing its value back in time to, you guessed it, the exact date of death. And for proprietary shares, think like expensive golf club memberships. You just use the bid price published in a newspaper nearest the date of death. It's all about finding the absolute most objective market reality on that single fateful day.
Finally, Part 5, our LECPA Rapid Bullet Review.
Okay, I need you to take a mental screenshot of this right now. These are the 5 absolute pillars of valuation that you need to instantly recall on exam day. General rule, date of death, fair market value. Real property, always the higher value. Personal property, purchase price for new ones or pawn times 3 for older ones. Listed stocks, the mean of the high and low. Unlisted stocks, book value for common, par value for preferred. If you have these cleanly mapped out in your head, literally no tricky word problem can throw you off balance.
And here is the real magic of what we just did. By connecting all these specific rules to the overarching logic of fair market value at the exact time of death, you're completely bypassing fragile short-term memory. You are actively building a 3-year analytical retention span. When you understand why the BIR uses a pawn value multiplier or why they take the mean of a stock's daily fluctuation, you stop blindly memorizing and you start analyzing. And honestly, guys, that is exactly how you conquer the LECPA.
So I'm going to leave you with this somewhat provocative thought to test out your brand new analytical framework. If an unlisted preferred stock was purchased exactly 15 years ago, how is it valued today for the gross estate? Think about it. Does the old personal property rule of pawn value times 3 apply just because it's an old asset? Or does the unlisted corporate share rule override it? Really think about which rule is more specific to the true nature of the asset. Keep analyzing, keep building those mental folders in your brain, and you are absolutely going to crush that exam.